And a weaker open following on a really, frankly, crummy session over in Europe. It's still going on, but generically, Europe is down about 1%. Just take a look here at Germany, France, Spain. Doesn't matter. Everything's in the red over there. The manufacturing numbers were weak. German manufacturing PMIs were really on the light side. So there is definitely some kind of slowdown. I don't know if it's a recession. Draghi seemed to imply, no, that's not going to happen. But there's definitely some weakness going on over in Europe. The good news this week is we've got some very good leadership from technology stocks. Semiconductors have had an absolutely great week overall. If you take a look at some of the things that have been going on here, AMD's just had a great week. Remember, Google confirmed that its gaming service would use the chips there, and that moved AMD up in the middle. Micron spun their earnings story forward, and they're up nicely. NVIDIA got dragged up. Xilinx is up. So nice leadership there. What is a little disturbing is how lower rates are impacting the market. So if you look at interest rate sensitive sectors today, utilities up, okay, REITs up, home builders have generally done pretty well this week, down a little bit, but done well overall. And it's that regional banks that everybody keeps talking about. I get asked questions about. You see the big names again today, 3 days in a row, big names all down 1%, 2%, 3%. You add it all up, you can get double-digit declines. In fact, heck, we are at double-digit declines. Look at some of these regional banks this week. Fifth Third, Comerica, KeyCorp, Huntington Bankshares. Let's not quibble. They're all down essentially 10%. And people keep saying, gee, why is this happening? And, oh, it must be the yield curve or something. A lot of these regional banks, if you look at this more closely, it's not so much the yield curve or the 2-10 spread that matters. Lower short-term rates generally hurt these banks. And it's a pretty simple equation here. If you look at where their books are, it's the short end of the curve that really moves them. So take a look. So commercial and industrial loans, for example, most of them commercial and industrial loans, they're variable rate, and that's tied to the shorter end of the curve. And when the shorter end goes down as dramatically as it has, the 2 years, for example, that hurts them. Most fixed rate, take auto loan, for example, they're also shorter durations. Where you get the 10-year getting really important here is, of course, when you have a book of mortgages. And then that becomes important. But if you look at most of these regional banks that I can see, most of them, less than 20% of the book value is mortgages. Most of it's that autos and what we call CNI, the commercial industrial loans. That's my point here. So when you get that 2-year dropping that rapidly this week, that's a sell the regional bank story, and that's what's going on here at this point. So you have no loan growth. We have 2 or 3% that we've been getting for the last several years. You don't get any move up because you can't charge anymore for the loans themselves. So you're stuck. And remember, the regional banks do not have big trading operations. I know we're obsessed with reporting the trading operations of the big money center banks. None of these regional banks have any of that. They've got to go on the interest rate scenario, and they've got to go on the loan rate scenario. And right now, neither one of them are particularly working for them. Carl, right now, we're right near the lows for the day, down 128 points.